The market continues to struggle to go anywhere. Still, we're going sideways. For the last 6 months, we've gone sideways. And maybe this $1 trillion market that's about to completely implode has something to do with it. Let's watch this together and see exactly what this is. And then I'll show you my trading plan as well.
Private credit default rates could surge 15% if AI triggers an aggressive disruption among corporate borrowers.
Unfortunately, we did see this in 05, in 06, in 07. Almost the same thing.
You could take more risk, you could lend to smaller companies, you could do more PIK, you could invest in equity and preferred, not just first lien, and you could run with a lot of leverage. That felt really good on the way up. That's not going to feel so good on the way down.
Ooh, hang on, let's hear that again.
You could do more PIK, you can invest in equity and preferred, not just first lien, and you could run with a lot of leverage. That felt really good on the way up. That's not going to feel so good on the way down.
It's like selling options. It's like selling options. It feels really good to sell puts on the way up. Let's go to SoFi. It feels really good to sell puts on the way up, but it doesn't feel really good to sell puts on the way down. Oh man, I think he nailed that one on the head. Yeah, let's keep going.
This is what it looks like when a $2 trillion industry collapses in real time. These are the share prices of some of the largest private credit companies.
Okay, help me out here. What are these tickers? What are these tickers? I remember KKR. I think we traded KKR not all that long ago. Let's go to KKR. Help me in the chat. I need Blue Owl. I need Apollo Global. I need Ares Management, and I need Blackstone. What are those tickers? Help me out here. So I swear we traded KKR not that long ago. Oh, but it's been a minute. It must have been over here back in December. Oh yeah, I remember that we had a really good string of really solid financial sector trades back in December. That was it right there. Now it's been sitting on a sell signal since December 22nd. Let's go measure that real quick. KKR. There's my notes. Look at that. Yeah, that's where I traded it. And oh, it was in June. It was in June. Yeah, I told you I traded it then. Okay, cool. So hang on. When was June? Got to zoom out just a smidge. Here, this move. That's the move we traded. This was before Plan M, because Plan M would have kept us in further, actually. That's pretty exciting. That's pretty exciting. Anyways, KKR sell signal came through on December 22nd. Let's go find December 22nd here. Let me remove all my notes here. KKR, December 22nd. Here. That's where we got the sell signal. Now, how far has it gone down since then? 35%. Yeah, not a great start. Not a great look for KKR. Yeah, this is not where I would be investing. But you know, there's people saying, oh, you want to go buy it right now? Buy that dip, baby. Buy the dip as it's crashing down. Yeah. It's really easy to see the direction of anything. You just put the 10, the 20, and the 50 on the chart. And yes, I say it every single day. Why do I say it every single day? Because it works. Because it's math, right? The trend is down for sure. Don't even think about buying these right now. What are ARCC is Ares. Let's go look at ARCC. And you thought that we wouldn't be looking at any of these stocks. Heck yeah, we are. Heck yeah, we are. ARCC got a sell signal back on January 28th. Okay, let's go see January 28th. ARCC, January 28th to today. Isn't this exciting to do these like in real time to see how they're going, right? I like it. I like it. About 10%, not as bad as ARC. Give me some more. Blue Owl is Owl, okay. Blue Owl, sell signal. Notice how all these sell signals came before the big, scary, nasty downtrend. So you don't have to hold it on the way down, right? That's the point of outlier. Get out of the way. Get out of the way when things are not working. January 14th on Owl, OWL. Whew, that one looks pretty bad. January 14th. Here, only down 43% so far. And Apollo, do we have Apollo? Do we have Blackstone BLK? Blackstone BLK. You know that there's some moron commenter who's gonna be like, don't you know what these tickers are? You call yourself a trader and you don't have every single ticker in the entire world memorized. February 3rd, the sell signal came through. All right, February 3rd, right there it is. All right, and then let's go from the top of that one down. Only 15%. Only 15%. Trust me, bro. This is the bottom. This is the bottom, baby. Don't you know? Don't you know? Let's see. Yeah, you don't know them? How could you? Yeah, that is a big nasty gap. You're right. So point is, all of these have had sell signals in outlier. So you've had some warnings if you were holding on to these that things were not looking good. Okay. So let's keep going.
Together, these make up 2/3 of the entire private credit market.
Hang on. That's BlackRock. Blackstone is BS. BX. It is some BS, I'll tell you that, but it's also some BX too. Why not? Yeah, that was a gap and go down. Actually, let's take a look. Yeah, gap and go down. Gap and crap, my friend. Sell signal on BX, which is Blackstone Inc. Financials. We've confirmed that. Sell signal December 29th, BX. Yikes, December 29th. Here. Okay. Now, I would say that if you were an investor in any of these companies, you would have been very happy to have paid 82 cents a day for Outlier. I'm just saying.
And all of them are down over 30% from their highs and falling rapidly. Blue Owl Capital that you see here has recently decided to permanently halt redemptions on its private credit fund. Many economists are already drawing parallels to some of the behavior seen in the lead up to the great financial crisis.
There you go. Now, that is interesting. That does sound scary. So let's talk about bank failures. So I worked in consulting with financial institutions, specifically credit unions, for 13 years. This is a big risk, right? Think about it this way. If you are a financial institution and you've taken $100 million in deposits, which is nothing, literally nothing. And let's say that one of the depositors is 50 million of that. Okay. Chris Chains has his money at your bank, and Chris he walks in the door and he's like, no, I'm saying I need my 50 million. I need my 50 million right now. Give my 50 million. And the bank, the respectable banker man who would never dress like that, they're like, sorry, sir. We don't have $50 million on hand. We are a $100 million institution. In order to give you the $50 million, because we're respectable people, we must go liquidate some of our investments and maybe call some loans or sell those loans off. And then Chris Chains is like, no, you give my monies right now. You better give my monies right now. How dare you think you be robbing me, right? So Chris Chains, he's losing his mind. And then Chris Chains goes out on social media. He tells everybody that the bank of G-Greek, the G-Greek bank, doesn't have his money. They stole $50 million from him. Right? Now, they have his money, but that money is put out in auto loans, mortgages, investments, all kinds of things. And it's going to take them a minute to liquidate those, right? So if they have the auto loans, they're basically going to sell that off to like Wells Fargo or something, right? If they have investments, they have to sell those off, and they could be at a significant discount. That's what it's called, a discount to par. Okay, par would be 100, and they might have to sell it for 80 cents on the dollar. That's not a good sign. Now, let's say that they had to liquidate $50 million of loans and combined $50 million of loans and investments, and they had to take 80 cents on the dollar. Well, that 50 million, they didn't collect 50 million. They collected 40. That's 80% of it. So then they got to go sell some more. So Chris Chains just absolutely took down the bank all at once. This is why there are deposit withdrawal limits, so that the big whales who do want to pull their money out can't just absolutely take out an institution immediately. There you go. There's your Finance Bro explanation for the day. What do you know about par?
And indeed, private credit firms are vulnerable to the same risks as traditional banks. They have investors that are providing capital, and these private credit firms then loan out this capital to other firms, and often with quite a bit of leverage, meaning that private credit firms have a lot more money that is loaned out compared to the amount of money that investors have given them. So theoretically, if all investors wanted to pull out their money at the same time, they would not be able to, because
No, they wouldn't be able to, because they got to go collect it. And like in the Chris Chains example, right? They might be able to get enough out of here, no issues. Maybe they'll get par. Maybe they'll get 100 cents on the dollar. In this tranche right here, they might not get 100 cents on the dollar. They might get 80 cents on the dollar. In this tranche here, they might get 60 cents on the dollar. So where they were a $100 million institution, by the time they get done with this, by the time they get to the point where they've liquidated, guess what their institution is really now valued at? They might be valued at $60 million. They might be valued at $70 million. And then you have one depositor, the big whale, who takes out his funds, which was half of it at par, but it's way more than half. It's like 80%, 90% of the institution was this one dude's money because they had to take these huge losses. That is a big deal. Huge deal. I don't know if they would do that. I really don't know. The FDIC, I don't know if that's something that they do.
The private credit firm doesn't actually have it. This is the equivalent to what's called a run on the banks, and it's exactly what's currently happening with Blue Owl Capital.
And then also, it doesn't have to be one individual, right? Let's say collectively, there's 100 individuals, 100 people with $50 million collectively, and they all want to take it out. And this institution may have, 20,000 depositors, but these 100 are the ones who really control the show.
The big concern is that this run on private credit firms is going to spread across the banking sector and cause real economic stress. In order to answer that, we need some context. The private credit industry has now grown to $2 trillion as of the beginning of 2026. That is a tenfold increase compared to what it was in 2010. The reason for this spectacular growth is because private credit has essentially absorbed all of the risky loans that were made by the traditional banking sector prior to the great financial crisis. Now, the big advantage is that these private credit instruments have yielded exceptional returns over the
I don't get the George Bailey reference. Who's George Bailey?
course of the last 20 years. They've outperformed all global stock market benchmarks. But as Jamie Dimon puts it, people are doing dumb things in order to continue chasing these returns in the private credit industry. For example, leverage ratios averaged 4.5x in 2015, but have recently been averaging closer to 6x in recent years. So to put this simply, each dollar that an investor puts into a private credit firm turns into $6 loaned out. This high
Now, this is where we come into issues, right? This is what's called fractional reserve. So they could take $100 million of deposits, but then make $600 million of loans or investments and other things, right? Ooh, that's scary. Yeah, and that's the reality too.
high leverage ratio have allowed these firms to generate very high rates of return. Now, a good chunk of these loans were made to companies in the software sector. This chart shows us the exposure that these private credit firms have to different sectors of the economy, and software is the sector that they have the most exposure to. And it makes sense. For the last 15 years, software has been the most rapidly growing part of the economy. Software companies tend to have high profit margins and exponential growth rates. Private credit firms ramped up their exposure substantially between 2017 and 2021, a period that coincided with a big boom in software stocks, taking up their exposure to the sector to roughly 20%. For comparison, this is roughly the same level of exposure that traditional banks had to residential mortgages in 2007. They were roughly at a 30% exposure at the start of the great financial crisis. And this is what's getting a lot of people on edge, because you may have seen from news headlines that this boom in software has been completely turned on its head. The displacement of the software industry is something that we've been talking about for years now. Hardware is the new scarce asset. This is why our favorite sector has been semiconductor stocks for the last 3 years now. In fact, we just changed our top 3 sectors that we think can deliver outsized returns in the rest of 2026. You can watch the briefing we made on this for free using the link below, and I can tell you software is definitely not one of these 3 sectors. This is the software sector's performance against the rest of the market, and we can see the large boom that occurred in software stocks in the late 2010s, which has since been completely reversed, with an extremely rapid unwind taking place just in the last few weeks out of the fear that AI is going to be displacing software-related business models.
And this is really seen in the S&P 500, right? Because we had, let's just back this out a little bit, right? Actually, let's change this to like monthly candles. No, let's go to weekly candles. Go to weekly candles, right? We can see this in the S&P 500. How do we see this? It's because the S&P is a market cap weighted index. So these big software companies, the ones that are big on this chart right here, who are they? right? NVIDIA, Microsoft, Apple, Amazon, Tesla, Google, Meta, these big software companies. And a lot of this area on the chart, that's where most of the money had gone to. Okay. Now, as they start to unwind, right, we've seen this huge move up over the last several years. It's hard to see right there. But as they're starting to unwind, not look so great, let's change this to year-to-date performance. Here we go. All right, some of these are looking really terrible, like Microsoft, Oracle, Palantir. NVIDIA's holding flat. You got others like Micron, Intel, they're up bigly. But that's where a market cap index is going to save you because instead of being invested in one stock, you're invested across multiple stocks. But that is how it's reflected in the fact that the last 6 months, it was so easy. I shouldn't say the last 6 months. The last 6 months, it's gone nowhere. And the previous 6 months, it was gangbusters. We're starting to unwind those. And so that's causing this topping pattern to be right here. Or at least that's how I'm interpreting it.
And if we zoom in on this chart, we can see that this most recent unwind has been incredibly correlated to the wipeout that we've seen on Blue Owl Capital and all of the other major private credit firms that we mentioned earlier. So this is not a hypothetical narrative. It is a real, tangible crisis that is happening right now and already has substantial repercussions on the market. Now, you might be skeptical that AI is really about to single-handedly take down the entire software and private credit industry on its own. And you're right, AI is not going to displace all software business models overnight. But the problem for private credit is that it doesn't need to. It just needs to make the investors that gave money to these private credit firms fearful enough to say, hey, I don't want this much exposure to software. Give me my money back. If enough investors do this, it forces private credit firms to sell their software loans at a moment where nobody wants the exposure.
And so by doing that, remember we talked about 80 cents on the dollar, right? Nobody wants those. That's why the market price of them is not 100 cents on the dollar. It might be 80 cents on the dollar. It might be 50 cents on the dollar. So your institution could be cut in half almost overnight in the asset value of the institution, but your liabilities are still off the charts, right?
In other words, they are forced to sell at a steep discount. This is exactly what's already happening with Blue Owl Capital. They had to sell $1.4 billion in assets to meet the demands of investors pulling out their capital. And they had to.
So I experienced something similar to that when I was consulting. There was a credit union in Texas that they had some really toxic investments. And when I mean toxic, I mean they were mortgage-backed securities that had a really low rate on them, but a really long duration. So I'll use round numbers here. Let's say it was paying 3% for 30 years. Okay. 3% for 30 years. And so to the marketplace, nobody wants that. Why would I want that, right? If I'm a financial institution, I need an investment. I'm not going to go get a 3% for 30 years. No way. Because right now, today, maybe I could get a 5% for 6 months. That's a way better deal. So if you want to liquidate that 3% for 30 years investment, you have to sell it at a huge discount, right? So instead of it being $100 million investment, maybe they're having to sell it for $50 million. And so because they do that, because they knock down the principal value by that much, that means the coupon actually goes up bigly. Okay, that's how finance bros work. Now, the institution that I was talking to in Texas, I remember I was talking to their CEO one day and he said, Chris, I'm just absolutely sick. Absolutely sick. And I was like, what's going on? And he's like, well, I have to sell $50 million of these investments off. And every single day I walk into work, it's costing the credit union $1 million in realized losses, $1 million a day to sell these off. This is the reality. This absolutely can happen. I've seen it firsthand.
Do this at roughly a 20 to 35% discount in secondary markets. So yes, this could get worse as the panic spreads across the private credit industry and investors pull their funds out of this scheme that has taken on too much risk. But now let's look at the real problem, and that is that traditional banks have also lent money to these private credit firms. According to the Federal Reserve's data, traditional banks have made $1.8 trillion worth of loans to non-depository financial institutions. This is known as the shadow banking system, which includes private credit. As you can see, traditional banks have actually almost doubled their loans to these firms since early 2024. So this is the interconnectedness between the traditional banking system and private credit. If we want to know how much risk of contagion there is, we can make some simple calculations. Of the $1.8 trillion that have been loaned out to the shadow banking system, there's roughly $500 billion that is actually loaned out to private credit. The rest of the money has been loaned out to financial institutions like hedge funds, private equity, and real estate investment trusts. If the entire private credit industry were to experience a 30% haircut as a result of forced selling like Blue Owl Capital, this would result in approximately a $150 billion loss for the traditional banking sector. Now, to put this number...
That's what we're talking about, right? Forced selling, having to write off 30% of the value, equivalent to $150 billion. Now, to Dave's point, right? The depositors, in theory, should get their full value back. Who loses in this case is the bank, is the institution. But if, for example, they have to sell off so much that they have half of their depositor money left, right? $100 million just sold off down to $50 million. They just paid that $50 million to Chris Chains. They got nothing. Let that sink in. The $100 million, right? Let's draw this out. Maybe I'll make it easier if I draw it out. All right. So $100 million institution, right? $100 million institution. They do, let's say they do mortgages. Let's say they do business loans. Let's say they do car loans. And then let's say they do like MBSs, mortgage-backed securities. Okay. And then Chris Chains walks in and he's like, well, let's draw Chris Chains. Give him a good hat. Give him a, the glasses, right? And then the grill. Yeah, boy, you know the deal. I need my 50 million back. And so Brian at the bank is like, oh, sure thing, my friend. So Brian, he's over here. He's like, okay, we don't have 50 million on hand. We might have 5 million on hand. So here's 5 million now. Here's 5 million now. I'll get you the other 45 million in 30 days. Chris Chain's like, oh, hell no, you won't. I want my $30 million right now. You son of a gun, I want my monies today. Don't you get it? Don't you get it? I'm mad. I'm super duper mad. Give me your money. Give me your money right now. So Brian, he's the bank manager, and he's like, okay, well, we're a $100 million firm. We're now 95. We're now 95 because we just gave Chris Chains his 5 million in cash that we did have available. We're going to go sell 20 out of here. We're going to go sell 20 out of here. And then we're going to go sell 5 out of here and 5 out of here because we need to replenish the 5 that we're keeping in the bank. So that's 50 total. So when we do this, you know what? We're not going to get par. We're not going to get 100 cents on the dollar. We might get 3. We're not going to get 100 cents on the dollar. We might get 2.5. We're not going to get 100 cents on the dollar. We might get 15. We're not going to get 100 cents on the dollar. We might end up with 12. So the total here, when they needed 50, right? They needed 50 to pay off Chris Chains. And let's say Chris Chains represents, 100 investors either way. Okay. What they ended up with was 3 plus 2.5 plus 15 plus 12. They ended up with 32. That's not so good. And you know what happens next is since they didn't have enough money to pay off Chris Chains, they got to go back to these and sell more of them in order to get just to the 50 that they tried to get in the first place. Because right now they just have 32. Type a 1 in the chat if you can see how very quickly this turns into nothing. Type a 1 in the chat if this is making sense. Because these items, I mean, honestly, they might be worth more, but they might not. And if you got to liquidate fast, what do you think is going to happen, right? You're going to take what you can because you've got somebody breathing down your neck, right? You got Chris Chains over here, and he's like, give me my money. Right? Give me my money. Yet, and then Brian's over here. Brian's like, I'm sorry, Mr. Chains. I'm not smiling here. I'm sad. because we sold $50 million of assets and all we got was 32 back. Well, that ain't my problem. Go get you some more. So Brian's like, oh, okay. And then there's nothing left. And it's gone. Exactly. Oh no, I just clicked far back over here. Hang on. Where are we at?
To put this number in context, this is approximately the same dollar loss that the banking sector suffered during the March 2023 banking crisis. And if we look at a price chart of the financial sector, this is what happened to the banking sector in the March 2023 banking crisis. It had some...
This example is what happened during the March 2023 banking crisis. Yeah, it's Silicon Valley Bank, and then you had Bank of New York, something like that. There was a New York bank that had this happen to them. This exact situation did happen. It is a real thing that can happen.
Some impact on the banking sector, but overall it was quite limited. In other words, even if the entire private credit industry implodes, it would have minimal impact on the traditional banking sector, let alone on the economy. Today, banking...
Hang on. So banks will be impacted, right? So they have to write this off. Right? The banks, these guys right here, let's say this private credit is, I don't know, a portion of the balance sheet. Let's say it's 10%. They're going to have to lose 10%. If this goes belly up, they lose 10% of their assets. Oh, that's not a big deal. You're right. It's not a big deal. Until a $100 million institution is now a $90 million institution, then it's a really big deal. B. Taylor says, real thing was 2008. I lived through that. I didn't even get the t-shirt.
Minimal impact on the traditional banking sector, let alone on the economy. Today, banking stocks have been declining and significantly underperforming the rest of the stock market as a result of this unfolding story in the private credit market. Once this is all set and done, we think this will reverse and the banking sector can actually stage a catch-up move here. Our mission is to provide you with accurate research on what is actually happening in markets and make sure that you profit from the panic rather than get caught up in it. You can click the video below to...
There you go. Decent video. We've watched some pretty craptastic videos. That was not a bad video at all. Now, granted, I don't follow a lot of news, so I've heard rumblings of what's going on out in the marketplace about this. But is this something you're worried about? I don't know. You tell me. I don't really pay attention to that stuff because I have a trading plan. And I'm going to go through that with you. It's linked down below. It's 100% for free for anybody who's interested, right? This is the invitation only live stream. And this is where we help you save time, make money, and start winning with less risk. So go ahead and subscribe. And then, as we have found, like and hype. It makes a huge difference, a tremendous difference. Like and hype. So we have 3 plans that we use. Plan M is our most aggressive. Plan ETF is when we want to be in the market, but Plan M isn't set up. And then Plan Sit in Cash. So let's take a look at these real quick. So Plan M that needs a SPY bullish trend. So a market having a bullish trend. We don't have that. We don't have that. We have the 10 under the 20, price under the 50. Now, how quickly is this going to take? I don't know. Your guess is as good as mine. And I mean that. There are YouTube charlatans out there who are claiming they know the exact bottom. They are full of charlatan. They are full of absolute monkey donkey. Nobody knows the direction. Nobody knows the duration nor the magnitude. All we can see is the direction. Now, it could be short, right? It could be a short-lived thing and turn right back around. Absolutely could. But we won't know until that happens. So right now, we are in a bearish trend for sure. The SPY needs a buy signal. Let's go to SPY real quick. SPY is a 0 of 9, by the way. SPY has a sell signal in place. So that's not going to help us. What about the fear and greed on SPY? Well, that's getting more fearful. Okay, that's not so good. What about surely the breadth has come around, right? More buy signals versus less sell signals. No, not looking good at all. In fact, technology is the only sector that has a bearish cross, but it's getting weaker. Every other sector is bearish. Every other sector is bearish. And you'll notice these little OCs over here. This tells you that every sector, every single sector is showing less uptrends, more downtrends. Now, there are people who want so badly to invest in the market, so badly, but not me, right? I'm looking at this, I'm looking at my plan, and I'm like, well, no, thank you. I'm not interested. So then we can go to plan ETF. You know, that's kind of our backup long plan here. Uptrend and SPY. Well, we know that's not the case. What about uptrend and Qs? Uptrend and Qs. We could go that way, right? No. Continues to have a bearish trend. A lot of support down here. A lot of support. But still a bearish trend. So there's nothing to trade, right? That doesn't mean that you need to be trading every day. You are not a compulsive gambler. You are not a gambler disguised as an investor. You are a professional investor who understands what it takes to be successful in the markets. And what it takes sometimes is sitting in cash, not effing up, sit in cash and don't F up. Now, where do we sit in cash? I sit in cash in SGov. What I love about SGov is that every single day I'm getting paid. Every single day I'm getting paid. No stress at all. And at the end of the month, it'll go down by the amount of the dividend that I've already collected during the month. And then just repeat. So for me, nothing to do. I'm going to be sitting in cash for a while. I'm going on vacation for like 2 weeks here in a minute. And I don't imagine that I'll be getting out of cash in that time. Now, how does this, but Chris, you're trading in the US Investing Championship, don't you? You've got to do something, right? Well, no, not really. I mean, I'll sit in cash. I'll collect a daily dividend. And wherever the standings are, where they're going to be. Right? I can't change that. I can't tell the market how much I'm going to get paid or when I'm going to get paid. But I can, and I have full control over sitting out of the way when things aren't working. And so do you. So do you. All right, listen, that's going to wrap it for today. Yeah, the first rule of OVTLYR is actually tell everybody you know about OVTLYR. That is the fact. That's the first rule of OVTLYR. The opposite of Fight Club. The second rule of OVTLYR is sit in cash and don't F up. Yeah. Now, why do we say that? Because imagine there's so many jokers out there who are trying to sell you on the fact that you should buy PayPal in this big nasty downtrend. There's so many jokers out there that say you should buy Netflix, right? Netflix is not looking so hot these days. I mean, it had a nice gap and go. We'll see if that holds. You should be buying Microsoft. You should be buying Meta. You should be doing something, because if you're not investing, then you're not a real trader. All right. That's it. That's it. You do you. I'll do me. Scoreboard end of the year. How's that sound? Verified investing, by the way, because all of my trades will be part of the US Investing Championship. So that's going to leave it for me. If you're ready to save time, make money, and start with less risk, click one of these 2 videos. We'll talk soon.